Hertz just shocked the entire car industry, and the fallout is already spreading across dealerships, automakers, and the used car market. When a major rental giant suddenly starts offering massive discounts on thousands of vehicles, it sends a message that something big is happening, and this time, it is even more disruptive than industry analysts expected. Hertz did not make this move for fun or marketing hype. They are sitting on a massive fleet of vehicles they can no longer afford to maintain, insure, or repair. Their electric vehicle strategy backfired. Their operating costs are soaring, and demand for rentals has shifted dramatically. So to stop the bleeding, they are liquidating inventory at prices that undercut both used car dealers and automakers. This is not a normal sale. This is a signal that the market is being forced to reset. For consumers, this is the moment they have been waiting for after 3 years of inflated car prices. These discounts are not small. These are price drops that instantly flip the value equation for used vehicles. Buyers who were priced out of the market last year are now finding lightly used cars, often under 2 years old, for thousands less than dealership listings. It is creating a rush. When Hertz unloads this many cars at once, and at these price points, it gives shoppers leverage they have not had since before the pandemic. If one company is willing to slash prices this aggressively, it pressures the rest of the market to match or lose business. Consumers gain power, dealers lose margin, automakers face a new pricing reality they did not prepare for. And the big question is what this means for the US auto industry, because the ripple effects will not stay contained to Hertz's rental lots. Automakers already struggling with high inventories, rising interest rates, and slowing demand now have to deal with an avalanche of discounted vehicles competing directly with their new models. This forces manufacturers to rethink production schedules, adjust incentives, and even halt certain vehicle lines. Wall Street is watching closely because this kind of fleet liquidation has historically signaled the first phase of a broader market correction. If Hertz is selling off this aggressively, it could trigger a wave of markdowns across rental companies, used car dealers, and even new car showrooms. This is how price wars start, and once they start, they are almost impossible to stop. The discounts themselves are what truly stunned the industry. Hertz is slashing prices on a huge portion of its EV fleet, including Tesla Model 3s and Model Ys, cutting thousands off their previous listed prices. Some units are dropping by 15 to 25% overnight. But it is not just electric vehicles. They are also unloading gas-powered models like Toyota Corollas, Nissan Sentras, Chevy Malibus, Hyundai Elantras, and even SUVs like the RAV4 and Ford Escape. Many of these vehicles have between 20,000 and 40,000 miles, prime used car territory, and Hertz is pushing them out at discounts anywhere from $2,000 to $7,000 below comparable dealer listings. In some markets, a used Model 3 that was $27,000 a few months ago is now showing up at $19,000. A Corolla that usually sells for $19,500 is suddenly $15,900. These are the kind of numbers that force the entire market to reset its pricing structure. And the most surprising part is that Hertz is not slowing down. The liquidation is accelerating, and industry sources say this is only the first wave. Hertz's strategy is now pushing every competitor into uncomfortable territory. Enterprise, Avis, and regional rental companies are quietly reviewing their own fleets because once Hertz floods the market with discounted units, the resale value of every rental vehicle drops instantly. That means their balance sheets take a hit, and they may be forced to follow Hertz's lead just to protect their numbers. This is where the pressure spreads. Automakers who depend on rental fleet sales, companies like Chevrolet, Nissan, Hyundai, Kia, and even Ford, now face the risk of reduced fleet orders next quarter. If rental companies hesitate or pull back, manufacturers lose one of their most reliable volume channels. That is why the industry is scrambling behind the scenes to understand just how large Hertz's sell-off will be and for how long. Dealers are feeling the shockwave too. Local used car lots that recently paid top dollar at auctions are now watching prices drop faster than they can adjust their listings. Many of these dealers were betting on stable inventory values through early next year, but Hertz's sudden liquidation has changed the playbook. When a national rental giant cuts thousands of dollars off cars that are under warranty and well maintained, it forces independent dealers to either match the price or watch customers walk away. This means shrinking margins, slower sales, and in some cases losing money on cars they purchased only weeks ago. And it is happening fast. Dealers are already lowering prices, updating ads, and rushing to sell aging inventory before the next wave of Hertz vehicles hits the market. The automakers that pushed EV adoption the hardest are also revisiting their strategies. Hertz's largest price drops are concentrated in electric vehicles because the company has realized that maintaining EV fleets is far more expensive and far more complex than expected, especially with unpredictable charging infrastructure and higher repair costs. This sends a warning shot to manufacturers like Tesla, GM, Ford, and Hyundai, who planned fleet sales as a major pillar of their EV expansion. If rental companies begin to demand fewer EVs due to cost issues, automakers will be forced to scale back production plans or introduce deeper incentives just to keep demand alive. Fleet rejection is one of the earliest signs of an oversupplied segment, and Hertz just triggered that signal across the entire EV market. Consumers, meanwhile, are entering a rare moment of opportunity, one that does not come around often. Anyone looking for a first car, a second car, a rideshare vehicle, or a daily commuter is now watching Hertz closely because these discounts are dropping weekly. Buyers who once ignored rental car sales are suddenly diving into listings, comparing VINs, and monitoring price changes because the value is simply too strong to ignore. Some consumers are even delaying new car purchases entirely, hoping Hertz's next round of markdowns will be even deeper. This hesitation is dangerous for automakers because every delayed purchase adds to unsold inventory sitting on lots nationwide. And this is only the beginning. Hertz's internal restructuring is far from over, and analysts believe the next phase of Hertz's strategy will involve aggressively trimming the types of vehicles they keep in their fleet, reshaping the lineup around models that are cheaper to maintain, easier to insure, and more reliable under heavy rental usage. This means the company may abandon entire categories of vehicles, especially the ones that have proven unprofitable or difficult to manage at scale. Electric vehicles appear to be the first on the chopping block, but insiders suggest that certain compact SUVs, high-mileage sedans, and even some premium models could be phased out as well. If Hertz follows through with this restructuring, automakers that relied on Hertz purchases for quarterly volume numbers will face a deeper problem. Without large fleet orders to stabilize output, factories may need to scale back production, delay new model launches, or increase incentive spending to stimulate retail demand. This shift also threatens the broader wholesale market. When Hertz dumps thousands of units at below market pricing, auction values decline across the board. Dealers who buy in bulk at Mannheim, ADESA, and regional auctions could see their inventory values fall faster than expected, especially for high-volume models like Nissan Sentras, Chevrolet Malibus, Hyundai Elantras, and Toyota Corollas. Historically, auction price drops lag behind fleet sell-offs by several weeks, meaning the real impact of Hertz's liquidation will not hit until the monthly reports show widespread declines. If those numbers fall sharply, lenders will adjust loan-to-value ratios, making it harder for buyers to finance used vehicles without larger down payments. In other words, Hertz's discount strategy has the potential to shift both retail and wholesale financing conditions at the same time. At the automaker level, the reaction is turning into quiet concern. Companies like Ford and GM are watching closely because Hertz's EV retreat calls into question the viability of corporate fleet electrification at scale. If rental companies cannot operate EV fleets profitably, then delivery services, corporate fleets, and public agencies may think twice before placing large EV orders. This challenges the narrative that EV adoption naturally grows through fleets before reaching full retail acceptance. Hertz's move disrupts that progression and introduces questions about long-term EV depreciation, maintenance economics, and charging infrastructure reliability. Automakers are now evaluating whether they need to redesign EV pricing models, adjust lease structures, or offer new incentives to keep fleet partners on board. Meanwhile, consumers are witnessing a market in transition. Buyers who monitor car prices will notice that certain segments, especially compact sedans and older EVs, are softening quickly. Hertz's liquidation is speeding up that trend. What was once a slow decline in used car prices is turning into a faster, more unpredictable drop. Some consumers are pausing purchases, waiting to see just how low prices can go. Others are rushing in, hoping to grab the best deals before inventory disappears. This mix of hesitation and urgency creates volatility, and that volatility is something automakers hate because it makes forecasting demand nearly impossible. And as Hertz accelerates its sell-off, the next shock to the industry could emerge from the financing side of the business. Banks, credit unions, and captive lenders are already assessing the sudden depreciation triggered by Hertz's liquidation. When thousands of vehicles drop in value at once, lenders recalibrate risk models, which may lead to stricter approval standards, lower lending limits, or higher interest rates for specific vehicle segments. This creates a chain reaction. When financing tightens, retail demand slows, and when demand slows, automakers are forced to introduce deeper incentives. Hertz's move could unintentionally pull the entire industry into a discount spiral, where everyone, from rental companies to dealers to manufacturers, must cut prices simply to keep vehicles moving. Insurance companies are also watching these developments closely. A sudden drop in used vehicle values affects total loss payouts, depreciation schedules, and premium calculations. If market pricing becomes unstable, insurers may raise premiums on certain models or adjust claim policies to account for the new volatility. EVs are at the center of this discussion. Because Hertz's biggest markdowns are on Teslas and other electric models, it signals that their long-term repair costs and total loss rates may be higher than expected. Insurers have already been nervous about EV claim expenses, and Hertz's liquidation reinforces those concerns. As a result, consumers shopping for EVs could face higher insurance costs even as used prices drop, potentially offsetting some of the savings. This complicates consumer decision-making and adds yet another layer of pressure on EV demand. At the same time, state and federal regulators are quietly monitoring the situation because Hertz is not just another seller, it is a major fleet operator whose moves can distort local and national markets. If Hertz's liquidation significantly affects state-level tax revenues, registration trends, or consumer financing patterns, regulators may consider stepping in with new reporting requirements or industry oversight measures. Historically, large-scale fleet sell-offs have influenced regional pricing in ways that affect consumer protection laws. With Hertz moving this aggressively, regulators want to ensure the market remains transparent and that consumers understand the risks and benefits of buying heavily discounted fleet vehicles. Inside Hertz, the company is undergoing a major operational reevaluation. Their executives are not only liquidating vehicles, they are restructuring their entire cost framework. That includes renegotiating maintenance contracts, altering fleet replacement cycles, and reassessing which automaker partnerships make financial sense moving forward. If certain brands prove too costly or too unreliable for rental operations, Hertz could permanently reduce purchases from those manufacturers. This would create a long-lasting ripple effect across industry production plans. Some automakers might find themselves suddenly losing thousands of fleet sales per year, forcing them to lean more heavily on retail incentives just to keep factories running. And the biggest unanswered question now is how far Hertz is willing to go. Industry analysts warn that this liquidation may still be in its early stages, and if the company decides to purge even more vehicles, especially higher mileage SUVs, and the rest of its struggling EV inventory, the next wave of price drops could be even more disruptive. The entire auto sector is watching cautiously because the next phase of Hertz's strategy could reshape inventory cycles across the nation. If Hertz accelerates the purge, automakers may be forced to slow production not just for EVs, but for several mainstream models that are already stacking up on dealership lots. Many manufacturers have been quietly battling excess inventory since mid-2024, and Hertz's sell-off is pushing those numbers higher by creating cheaper alternatives that siphon away retail demand. When a buyer sees a 1 or 2-year-old Corolla, Elantra, Malibu, or Sentra priced thousands below a brand new model, the decision shifts instantly. New car inventory sits longer, floor plan financing costs rise, and dealers begin pressuring automakers for more aggressive incentives. This cycle can turn a manageable inventory problem into a full-scale pricing crisis in a matter of months. Meanwhile, rental car demand patterns are changing in ways Hertz cannot ignore. Business travel has stabilized but not recovered to pre-2020 levels, and leisure travel is growing more unpredictable. These swings make it harder for Hertz to justify carrying a massive, diverse fleet. Instead, the company is leaning toward a leaner, more efficient model, one that favors reliability over experimentation. That means more proven sedans, more compact SUVs, and fewer specialized models that sit unused for too long. This will reshape the future of what kinds of vehicles consumers can expect to rent. It may also alter what kind of used vehicles hit the market in the next 3 to 5 years. The downstream effect is massive. A shift in the rental fleet today becomes a shift in the used car supply tomorrow. Another major impact that industry insiders are watching is fleet mileage timing. Hertz is selling cars earlier than normal, offloading vehicles with 20,000, 40,000 miles instead of running them up to 60,000 or 70,000 miles. This creates a younger used car market with fresher inventory, something consumers love but dealers dislike because it compresses resale values and reduces profitability. Younger used cars entering the market en masse forces down the price of older used cars as well, narrowing the spread between a 10-year-old model and a 2-year-old one. That makes the older models less attractive, hurting small independent dealers who rely on inexpensive high-mileage inventory. In addition, Tesla's position in all of this is uniquely sensitive. Hertz's early enthusiasm for Tesla was supposed to be a landmark partnership, a sign that EVs were finally ready for mainstream rental adoption. But now, with Hertz unloading thousands of Teslas at steep discounts, it sends the opposite message. This affects not just Tesla's brand perception, but also its used vehicle values, which are already highly volatile. If Hertz continues to drop prices, Tesla's market-wide depreciation curve steepens further, creating pressure on new Tesla prices, trade-ins, and lease residuals. Other EV makers, Ford, GM, Hyundai, Kia, are watching with concern because their fleet ambitions depend on Tesla proving the economics work. And while all of this is unfolding publicly, the quiet conversations happening behind closed doors are even more telling. Analysts say automakers are already approaching Hertz to renegotiate future fleet deals, offering more favorable terms to keep the relationship alive and prevent deeper sell-offs. Some are proposing lower purchase prices, revised warranty programs, and even maintenance support agreements. This level of negotiation shows how seriously the industry is taking the situation. When a rental giant starts rewriting normal fleet economics, every supply chain partner is forced to adapt or risk losing a major source of recurring business. But the biggest long-term consequence may come from shifting consumer expectations. Shoppers are now seeing something they have not seen in years: sharp, rapid, market-wide price drops. And once buyers get used to discounts of $2,000, $4,000, $7,000, they become reluctant to pay full price ever again. This psychological shift puts sustained downward pressure on the entire auto sector, and if Hertz continues its liquidation at this pace, the next major shock to the industry could be even more destabilizing as consumers begin delaying purchases on a larger scale. When buyers believe prices will keep falling, they wait. And when they wait, demand drops across the entire retail market. This is the exact scenario automakers fear: a deflationary mindset creeping into the car buying public. If consumers expect future discounts, they refuse to commit today. That hesitation creates inventory buildup, forces deeper incentives, shrinks dealer margins, and ultimately drives automakers to reduce production. Once this cycle begins, it becomes extremely difficult to reverse. Hertz's liquidation is not just moving metal, it is rewiring consumer psychology in real time. This shift will also influence lease pricing. Leasing has already struggled due to high money factors and inflated residuals. Now, with used car values falling faster than expected, lenders will likely reevaluate residual values on upcoming leases. Lower residuals mean higher monthly payments. Higher payments mean fewer consumers choose leasing. That pushes even more buyers into the used market, exactly where Hertz is dumping vehicles. As leasing declines, the entire new car ecosystem loses one of its most important sales channels, and that forces dealers to depend more heavily on cash buyers and long-term loans, both of which are sensitive to interest rate environments. The market becomes more fragile, more unpredictable, and more vulnerable to sudden shocks. Hertz's move also exposes which brands hold their value and which brands struggle. Models like the Toyota Corolla, Toyota Camry, Honda Civic, and Honda Accord are holding up reasonably well even amid the sell-off. But other models are depreciating far faster. Nissan sedans, certain Chevrolet models, and entry-level EVs are taking the biggest hits. Hertz's pricing reveals very publicly which vehicles the market trusts and which ones struggle when the pressure hits. This data is extremely valuable and extremely uncomfortable for automakers. It may influence future product decisions, trim reductions, and even determine which vehicles are discontinued over the next 2 to 3 years. Meanwhile, the logistics of moving so many cars at once is creating ripple effects behind the scenes. Transport companies are booking out weeks in advance. Detailers and reconditioning centers are overwhelmed. Auction lanes are seeing unusual spikes in volume even before Hertz officially lists some units. This surge in processing activity is a strong indicator that Hertz's liquidation is not slowing down. The operational footprint required to dump this many vehicles is enormous, and the company would not mobilize this level of infrastructure unless it it was fully committed to clearing space rapidly. From a financial standpoint, analysts say Hertz is betting on a short-term pain, long-term stability model. They are willing to take losses now to rebuild a fleet that is cheaper to run, easier to maintain, and more aligned with current travel trends. They want a fleet that is profitable, predictable, and operationally efficient. But the price of achieving that restructuring is being paid by the entire auto market. Dealers are absorbing the depreciation shock, automakers are adjusting production forecasts, consumers are rethinking timing, and investors are recalculating the long-term value of fleet sales. As Hertz continues to reposition itself, the next phase could involve even more aggressive moves, especially if, as Hertz continues to reposition itself, the next phase could involve even more aggressive moves, especially if economic pressures intensify, if travel demand softens or operating costs remain elevated. Hertz may expand the liquidation beyond EVs and sedans into mid-size SUVs, crossovers, and even certain premium models. This would introduce a fresh wave of high-demand inventory into the used car market, putting additional pressure on both mainstream and luxury manufacturers. The company may also revise its vehicle replacement cycles, moving to shorter-term fleet refresh strategies that bring younger cars into the market more frequently. These choices would permanently alter the rhythm of America's used car supply. The industry will also be watching whether Hertz begins renegotiating long-term agreements with automakers. Some manufacturers may offer exclusive bulk pricing to keep Hertz loyal, while others may pull back if the resale pressure becomes too damaging to their brand's residual values. These negotiations could reshape the rental manufacturer relationship for years. If Hertz shifts its loyalty toward only a handful of brands based on cost, durability, and fleet economics, it may leave other automakers scrambling to find new ways to move volume.